Hi, Matt McAleer, Director of Equity Strategies, February 17th, just after the close. I'm with John Mousseau, President and CEO at Cumberland Advisors. In terms of what we saw this week, we're going to get some descriptions from John. Had some action in the bond market. Although, when we look at the 10-year closing at 385, somewhere in that range, it's kind of in that bracket that you've been talking about, 340 to 4, 3. What do you think there?
Backing and filling. We're basically back on the 10-year Treasury, which we use as the indicator for bonds, for better or for worse. You're back to where you were at the end of last year. Not a bad thing, not a good thing. What does it reflect? It reflects some angst in the market. We had CPI and PPI this week. They're a little higher, but on kind of expectations, maybe PPI a little higher than expectations. But what the market is concerned about is not that the pace of inflation isn't coming down. It is. But the rate at which it's coming down is starting to flatten out. And so that has a lot of Fed governors talking. And some are talking about keeping a 25 basis point increase, which we had last time. Some are saying we need 50. Some are saying we need 50 and then reconsider. So you're having a whole host of opinions there. And what happens to traders when they see a whole host of opinions? They fade the market. And that's what you saw this week. So the 2-year bonds back at around a 465, very high. 10-year bonds back to where we saw at the end of the year. Important to remember that the high in that 10-year bond was back at the end of October around a 425. I don't think we're going back there unless we get some really, bad news on the next round of inflation numbers. Because the backdrop is still slowdown, whether you're talking about real estate, whether you're talking about commercial real estate, whether you're talking about commodity prices, talking about layoffs. All these numbers combine to say we're slowing down, but yet you still have enough in the pipeline going that it's keeping the Fed moving rates up.
Yeah, good points, John. And you mentioned energy prices, right?
Right.
And we saw energy stocks play catch up to the barrel this
Sure.
week. We have been talking about how the barrel, if we look at West Texas crude, trading in the mid-70s, down from over 100 a year ago, but down from that 80 to 85. But stocks had been solid. Exxon, Mobil, even on the servicing side. Not this week.
No.
XLE, which is a broad ETF that people track for energy, down 6%. Big loser on the week. Other than that, the market's kind of traded back and forth. We didn't see any big breakouts in any sectors other than energy with the breakdown. I wanted to show a chart today. We talk an awful lot about small cap, mid cap, large cap. Do we go growth, value? I wanted to introduce a couple other factors just to take a look at how they're trading year to date. This is a year to date chart, folks, so this is very short term, but it gives us an idea versus the S&P, what's working and what isn't working. So remember, this is versus the S&P. So when we look up to the far right, to the red line, that IWF represents growth. Growth is outperforming the S&P by over 3%. The converse of that is down below. Momentum is underperforming the S&P by 8%. Now the S&P is up about 6.5% year to date, meaning momentum is probably down about 2% year to date. What that tells me is that what has been working isn't. Right? Momentum and how that ETF works, it runs screens on what's showing the strongest relative strength and relative value. And that's turning over those areas. And we've seen that. In motion. So you have a choppy market. You had growth come out of the gates the last couple of days in December through early February. You've seen the last couple weeks a little push back into the defensive sectors. Nothing earth-shattering. But you've seen a little bit in healthcare. You've seen a little bit in utilities. You've seen a little bit in staples. Let's see if that's just a reversion to the mean or if capital is going to flow back to those areas like it did last year.
Right.
What happened? Rates went higher the last couple of weeks and last year's template came back.
Absolutely.
Money into the defensive. Keep an eye on the dollar. the dollar has quietly started to get its feet back under it. Remember, we talked about the dollar over and over last year, how strong it was and how that was difficult for our equity market. The dollar sold off, and almost by the week, the equity market started to rally. Dollar's starting to bounce here. Let's keep an eye on that. A bounce is expected. Markets revert to the mean.
Absolutely, and that's a great point on the dollar, because when you started to see the dollar in retreat a little bit and coming down, right? And what did you see? You saw bonds rallying, and suddenly, stocks took off, like you said. And then as soon as you get that goosing up a little bit of the dollar, it's a stall.
Yeah, we'll keep an eye on it. In terms of what we'll be looking at next week, John will be looking at inflation data. I'll try to be following flows in the equity markets. We'll report to you on Friday. Don't forget to like, comment, and subscribe so you can follow along. Have a great weekend. Enjoy President's Day. Markets not open on Monday. See you next week.